All right, here we are, ready to rock and roll this morning, bright and early. First thing after having a nice class last night. It's great to see everybody down at the university. And so those of you who are here joining us today, not from the university, this is the university lab for the class that we had last night. And don't feel like you can't come and join us. Of course, everybody's welcome to come to the lab here on the internet with us, but nonetheless, this is the lab for the class that we had last night down at the university at Utah Tech University. And so welcome to the lab class, people. We are going to jump in here and we're going to jump right in because we got a short time and a long time to get there. All right. Actually, it's the other way around. We got a short time to get there and a long ways to go. So I want to just review some of the things that we talked about last night and show you how to actually implement them. So that's the name of the game today. All right. In this lab, we're just going to go through and we're going to play with the software and look at some of the stocks that we talked about last night. So as we slide down through our slides, I'm going to go all the way down to the section where we had we started with level 1, right? Investing strategies, capital growth. And we have a list of stocks here that we talked about. We call it the Magnificent Seven: Tesla, Facebook, Alphabet, Amazon, Apple, Microsoft, and NVIDIA. And then we have the blue chips: Eli Lilly, JP Morgan, Walmart, American Express, Oracle, Wells Fargo, and Costco. So I'm going to show you how we're going to go look at these. All right. And we're going to start diving into a little bit of the ability to analyze these markets, look at them from a technical standpoint. I do have a technical standpoint class coming up. We're going to take, I think it's like the first week in March. So we're going to go dive deep into how all this is done. But right now we're going to go in and we're going to show you how to create a portfolio, how to pull these stocks up, and how to start analyzing them for decision making on whether we want to buy them or not. All right. And then we're going to go down. If we got time, we're going to go into level 2 and we're going to come down and we're going to look at some of these ETFs that we talked about. All right. Because we have a stack of ETFs, a nice list of them that we can go and create another portfolio for, and we're going to look at those. So that's the goal for this class, just to go create some portfolios and look at some of these really cool stocks that we talked about in level 1 and in level 2 trading. Okay. So this is level 1, level 2, and then of course we start level 3. We started level 3 last night just with an introduction. We got to level 3, but level 3 is kind of what the whole class is all about, right? Becoming an entrepreneur. And I'm starting to change your mind, and I want you to start thinking in a different way about how we manage these positions. And this is what we're going to talk about tomorrow night, Wednesday night in class. So I want to make sure that everybody shows up so that we can go in and we can start bending your mind, changing your mind. Changing your mind is just learning, right? So we're going to learn how to think like an entrepreneur in the stock market. Okay, so that's what we're going to do starting Wednesday night. And then so today, and then we'll have another lab Thursday night where we'll go in and we'll dive deep into the software and how we can do that and what software tools we've got available to us to help us make that happen. All right, because it's all about how we make it happen. Okay, so first of all, we're going to take this, our most popular high growth stocks, capital gain stocks, and we're going to go build a couple of portfolios. Let's build the Magnificent 7 portfolio and the blue chip portfolio. So I'm going to go over into Track and Trade, and this is the software I use. You can use a different software if you want. Whatever software you've got, you're going to have to build a portfolio. I use this software. So if you want my help, then this is how you do it. All right, using the software I use. So I'm going to come up here to the right-hand side and I'm going to click New. And I'm going to say New, and I'm going to call this, I've already got one called Magnificent 7. So let's have Magnificent 7 Plus. Let's just call this old, the old Magnificent 7. Now we're going to create a new Magnificent 7, and we'll just call it Mag, because we went and put a whole bunch of stuff in there. This is just going to be Mag 7. All right, so we're going to say Mag 7. We're going to say OK, and that gives us a new portfolio. Now you see I got a drop down with all my portfolios in here. I got all kinds of portfolios. If I want to get rid of one, all I have to do is just click on it, bring it up, and then I can hit delete, and it'll get rid of that one. So the way we now put our stocks into the portfolio is we have this enter the symbol right here. So we come up here and you can see I got the control panel here on the right hand side, and this gives me all the tabs up at the top. So these are my preferences, my notes, my data, my options, my trading tab, so I can have my trades in here, all kinds of stuff, right? But we're on charts right now, and we're just going to add the charts from the Magnificent 7 list. And of course, that's Tesla, Meta, Google, Amazon, Apple, Microsoft, and NVIDIA. So these are all of our high-tech stocks, ones are making the markets move like crazy. Oh my gosh, look at my shirt. That's crazy. Look what it's doing to the screen. I don't know if you guys see that. All right, so we're going to go in Tesla, Meta, see if we can remember them. You think we can memorize all those? So it's Apple, Amazon. I keep wanting to say Netflix, but Netflix is not part of the Magnificent Seven. It was one called FANG, F-A-A-N-G, and that had Netflix in it. But this is Apple, Amazon, Google, Tesla, L-A, and Meta, which is M-E-T-A. What else? What am I missing? NVIDIA, NVD, NVDA. What am I missing? Let's open those up and see which ones I've got. Apple, 1, 2, 3, 4, 5. Uh-oh, it doesn't like that. It's AAPL. AAPL. All right. So we're going to take Apple. Add Apple to our list. And which one am I missing? Tesla, Meta, Alphabet, Amazon. Did I get Amazon? Oh, I did get Amazon. Apple, Microsoft, MSFT. 1, 2, 3, 4, 5, 6, 7. How can you forget Microsoft? All right, here's Microsoft. Look at this. Microsoft way down here in the bottom of the barrel. That's a good place to buy in Microsoft, I would say. All right, so now we're going to come through and we're going to create our other portfolio, and we're going to call it the blue chips. All right, so we're going to come in here. We're going to say new, and we're going to call this one blue chips, B-L-U-E, chips, blue chips. And we say, okay. And now we're going to come up here and add those in. Now we can add them in one at a time, or I want to show you. Well, you saw me. I can comma separate them in there. So we can do Leli, Lilly, JP Morgan, right? So we can go LLY, comma, JPM, comma, and then I can just string them along. And what that does is it makes a really neat little strategy so that you don't have to type them if you don't want to. Watch this neat little trick. So now I'm going to show you another neat little trick. So I'm going to pull up Microsoft Excel, because a lot of you guys have Excel. A lot of you use spreadsheets. And so what you can do is you might have in your spreadsheet a column, or you can copy and paste out of websites a whole column of stock symbols, and you can paste them into Excel, and Excel will put them in a column. And if you have them in a column, what you can do is we'll come and put them in here. We're going to type them in here. Eli, actually, I don't know if I can do it. Let's try it. We're going to pull it right off of here. Let's try this. All right. Going to go control C, copy, go over here, hit Control V, and sure enough, it put them all into a column. Now, the problem is it didn't separate the column. So I've got all of the words in there. I need it in a column like this. So we're going to go in here, and I'm going to go LLY, JPM, WMT, AXP, ORL, WFC, COST. Okay, so now I got them in here. So pretend like that worked. And you got them in a column. So now you can grab that column like this and just go like this. You can go Control C. Control C. You can copy those. And then you can come over here into Track and Trade. And you can just paste them right here. Control V, paste. See that? Now I hit open column, and there they go. Boom, 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 boom. So you can copy paste symbols. Uh-oh, we mistyped Oracle. How do you type Oracle? Oracle, which Oracle do we want? We want the ORL, or ORCL. ORCL. Yeah, we'll just type it in there. ORCL. I mistyped it. Okay, there we go. All right. Oh, I still mistyped it. Got ORLA. I want ORCL. Is that what it is? Yeah, ORCL. Oracle. I got to get rid of this one. So all we do to get rid of is we just right click on it like that and say delete all ORLA charts. We don't want those. All right. Oh, look at Oracle. Beautiful place to be buying Oracle. We want to buy some Oracle down there. Buy low, sell high. Anybody ever told you that? I don't want to buy it down there, Lan. I'm going to wait till it gets up here and breaks all-time new highs, and I'm going to buy it way up here at $328, and then I'll feel sick about myself because I could have bought it at 164 and I didn't. But that's okay. I'm going to buy it up here because I like that strategy called buy high and sell higher. That's a really hard strategy. I don't like that strategy. But if you like that strategy, you can wait for that market to get all the way back up there again. Then you can buy it. But I like to buy it down here. All right. I buy it down here. Like back here, everybody was like, oh, nobody wants to buy it down here. Nobody wants to buy it back here. Why not? Well, because it was coming down. See that? Nobody wanted to buy Oracle right here. Why would you ever buy Oracle right here? That'd be a terrible place to buy Oracle, right? Don't want to buy Oracle when it's way down there. Okay, don't do it then. All right, that's how we do it. I mean, how much more difficult than it can be than that? All right, I'm going to teach you a little trick, all right, for when to buy into stocks. We're going to come in here. And how many of you have Pitt News Magazine? How many of you have Pitt News Magazine? I know everybody in this group has Pitt News Magazine, don't you? Don't you? Y'all have it. So let's come and look at this month's version. This is Pitt News Magazine. This is a website. All right, so this is the website. And you come in here and you hit that little subscribe button right there. And that's going to subscribe you to Pitt News Magazine for $39 a year. You get the first two months free, or actually for $1. You have to pay $1. And then you also get this book right here. This is the 5 Pitfalls of Covered Calls Solved, How to Trade for Income. This is a book that you get as part of that. Okay, helps you trade options. And you're like, Lan, I don't want to trade options. Well, you get the book anyway. Okay, so we're going to look at the February issue, all right, the Valentine's issue of Pitt News Magazine, and it's right here. And here's the Valentine's issue of Pitt News Magazine. If you don't have this, you got to go get it. Okay, now I'm going to go right to the article I'm interested in, which is this one here by Claire Christensen. All right, Decision Point Trading, How Decision Points Change the Way I Enter Trades. There's Claire right there. Nice, pretty picture of Claire at the Dixie Rock with me. We went up there. Nice little trip. And here's how Mr. Turner helped Claire simplify the way to buy into the market. And you want to read this article. You want to get this article. And it talks about the 100 period moving average, the 200 period moving average. It talks about the delta Kona probability, which we talk about in this class ad nauseum. Right? So we always talk about delta Kona probability, but sometimes knowing and understanding how to apply the delta Kona probability is a little bit difficult for people. So I tried to simplify it for Claire, and she wrote an article about how I told her to do it. And it's all right here in Pitt News Magazine. And it teaches you with all the signals and everything and how to do it. And so we're going to go over. And then, of course, we went into portfolio matrix and talked about that. And that's the article. So I want you to come and read this article from Claire. You don't actually even have to read it. You know why? Because we recorded her right there. There's her voice. I don't know if you can hear it. I don't know if you can hear that. Probably can't hear it. So you click that, and then it just plays for you, and you can listen to it being read to you. Pretty cool, right? All right, so let's come back over here. And there's another picture of Claire right there. She's takes care of the on-air podcast. So if you want, she's a little behind right now. She hasn't posted one in a few days, but there is one. She actually did post one. I take that back. Because why? Because it's in the magazine. She also does one right here. She's the host of Pitt News on Air, and that's she's supposed to do more than one. She does one a month. She's supposed to do 2 or 3 a month. Yeah, you don't get the recording sound. I needed to turn that on in the system when I first turned it on, and Kirk, I didn't turn it on, so the sound I know is not coming through. So that's the podcast right there. So if you click that, that'll play the podcast, and Claire will introduce the podcast for you. All right, so that's the Pitt News on Air podcast. So she also does other ones. The podcast though is free. If you want to come down here, there's no cost to subscribe to her podcast. It's on. Well, it posts everywhere you get podcasts. And then the store on Pitt News Magazine. I always got to come to the store because there's stuff you can buy, but you can also get free stuff. There you can buy the magazine. You can buy the Orion Protocol. You can look, this is a free stock options playbook. Just download the PDF here. Here's a nice little book you can get for free, PDF download. So there's free stuff in there. And then there's, of course, the manual. All right, to the class. All right, so that's Pitt News Magazine. That's the stuff that we're looking at in Pitt News Magazine, and the article I want you to look at is this one right here. That's Decision Point Trading. So we're going to go back over to our software, and we're going to apply Decision Point Trading to this market. I'm going to turn off bulls and bears, And we're going to turn on, actually, I do need that on, don't I? We're going to turn that on anyway. Turn bulls and bears back on. So the way I turn that on and off is I right click on the screen. I'm going to come over here to MACD. And MACD, we turn off the arrows. I don't need those. All right. So we're not using the arrows. And generally, I don't use MACD for this standard purpose, but we can use it. It's okay. It's a good little indicator. So what we're going to do is we're just going to turn on chart overlays, and we come down here to moving averages, and we're just going to use moving averages, make it really simple on ourselves. So 100 and a 200 period moving average. That's it. 100 and a 200 period moving average. So once you have those turned on, you actually have what we call basically the delta cone of probability laid over the top of your chart. So if you take the Fibonacci ruler and you draw that from high to low, for those of you who are familiar with Fibonacci, you can see the delta cone of probability in here, or the Fibonacci sweet spot between 38.2 and 61.8. Now the market on this one, this is the one standard deviation, okay? This up here, this is the 2, goes up to the 2 standard deviations. That's not a box. So this is the 2 standard deviations up here, and then this is the 3rd standard deviation up here. Of course, then it goes down the other way. So this is 2 standard deviations to the downside, and then 3 standard deviations to the downside. So this center one is the 1 standard deviation. All right. If we were to look at that on our little chart, which I'm going to pull up here real quick for us as well, slides, and we're going to come down to our standard deviation slide, which is right here, somewhere close, I swear. It's right here. I thought I had that one up, and then I had the other one up. Oh, it's up here. It's by the options. Yeah, right there. Okay, there it is. So right here. Okay, that's the standard deviation. Sorry, it took me a second to get that. But you can see right here, this is the 1 standard deviation. That's what I call the Fibonacci sweet spot. This is the 2 standard deviations, all right, up above the sweet spot. This is the 3rd standard deviation. Markets have a tendency, approximately 68.2% of the time, to stay inside that 1 standard deviation. They like that. And then if they leave that standard deviation, they have a high probability of returning back to that 1 standard deviation, because that's where they like to hang out. So 94% of the time, they fall within the 2 standard deviations, which is down here. Actually, around 94, they fall within 2 standard deviations. So they fall within this region. And then it's all 99.7% of the time, they fall within the 3 standard deviations. So what happens is if it gets up to the 3rd standard deviation, which we call the 3 drive pattern, and market's cranking up out of that 3rd drive, that's getting to a point where the market's going to, the likelihood of it leaving that 3rd standard deviation is really low. It stays within 3 standard deviations 99.7% of the time. So once it gets way up there to the very top, the chance of going to 4, 5, 6 standard deviations is really low. Not that it can't, certainly can. It's just that the probabilities are very low. So for us as traders, we play the probabilities. So if a market gets way up there, we don't want to be buyers at the top of a 3rd standard deviation. And if it gets way down here at the 3rd standard deviation, we do want to be buyers. That's where we want to start buying in. Now, we don't know how far the market's going to go. It can go to 4, 2, 1, 0. It can go all the way down 3, 4, 5, 6 standard deviations to the downside as well. It's just the probabilities say that it's very unlikely. So we want to be buyers when it comes back down into this Fibonacci sweet spot. And if it goes down to and breaks the 1 standard deviation, hey, that's great for us. We'll buy some more down there. Oh, if it goes down and breaks the 2 standard deviation, oh, that's really great. We'll buy some more down there. What about that? Oh, we'll buy some more down there. But we got to be buying good companies. We don't want to be buying crappy companies that are going out of business, right? If they're going out of business and they're not making any money, well, you don't want to buy them, because those are the ones that go down to 4, 5, 6, 7, 8, 9, 10 standard deviations to the downside. You don't want to own those. All right. So we want to make sure we're only trading good companies. And these that I brought up here, these are good companies. So you can buy them when they're down here in this 3rd standard deviation. And that's where you want to buy. Okay. So if you don't want to draw all these little boxes, and you don't want to draw Fibonacci rulers, and you don't want to learn all about the delta cone of probability, well, you can do this very simple with the moving averages. All right. So we got a 100 period moving average. We got a 200 period moving average. And we're going to come in here and we're going to make those a little brighter for you so you can see them on the YouTubes. All right. All right. So there we go. Now this is the 200, this one here. So if it drops below the 200 period moving average, well, now you're going down below the delta cone of probability. So the delta cone of probability is between the 1 standard deviation and the 2 standard deviations are right here. This is the delta cone of probability. There it is. Okay, so it's the same thing as drawing our Fibonacci ruler, but we're using moving averages. So now we got everything above there is the upside, right? And it comes down here and does it at the same time on the other side. But right here, this market's coming down through the one standard deviation, and now it's down here below the 200 period moving average. So we're down in the 1 and 2 standard, negative 1 and 2 standard. This is the positive 1 and 2 standard deviation. This is the negative 1 and 2 standard deviation. And you know you're in the negative because your MACD down here is below the neutral line. So the neutral line right here, when that crosses, you've gone below the standard deviation. So there's the standard deviation. You draw a vertical line on it right there. It crossed right there. Therefore, let's fix that. There you go. So therefore, that is where it come down and it started to break according to the MACD. Now the MACD is also nothing more than just the delta cone of probability. It's a standard deviation as well. Okay, so it's telling you this is above the standard deviation, this is below the standard deviation. There's just the one line. The Fibonacci ruler actually gives you, when you do the Fibonacci ruler, it actually gives you not just one price, it gives you a price area. Okay, so see right here, this is where the MACD says that it crossed right there. Well, that's 38.2, which is the top of the one standard deviation between 38.2 and 61.8. So it's a box right here. Okay, and you can see how the moving averages are showing that box right there. That's the MACD crossing right there, coming down into the standard deviation. Now we're down here 1, 2 standard deviations away. So you can see here's the 1 standard deviation, here's the 2 standard deviations right here, and then we got 3 standard deviations down in here. This thing came all the way down to 3 standard deviations. That's crazy. So Oracle, this would be a good place to be buying some Oracle. Unless, you know, are they going to go out of business? I don't think Oracle's going to go out of business. They got a little competition. That's why they come down. And they were making a lot of money up in here because they were building and building and building, and they got a little competition. But we can go over and look at some fundamentals. There's a website I like to use for that. We're going to swing on over here to a little website called Finviz. I like this little program because if we bring up ORCL, now the chart's kind of, you can't do anything. They're really hard to work with, but they show you price. So there's the price, kind of like we're looking at on, and you can't build portfolios. You can't do any of that stuff. But what they do well is they have this little section down here, and Track and Trade doesn't have this little section. So you kind of use different tools for different purposes. I like all the charting and all the tools and all my portfolios and all my trading over in Track and Trade, but when I need the fundamental stuff, I have to go out to the web and find some fundamental stuff. And this little company has nice little fundamentals. So you can see over here, you got your sales, you got your PE ratios, you got your floats on the stock, you got your EP, your earnings per share, you got all kinds of stuff in here, all right? And you're like, I look at that, that doesn't mean anything to me. Well, you know how you find out what all this stuff means? You take a picture of it, give it to Grok and say, Grok, tell me what all this means. You don't want him to tell you all the stuff. Just say, tell me the 5 most important things I need to know in that table. And he'll go through and tell you just the most, and then you can say, well, why is that important? And then he'll tell you. But right here, what we're looking at, they've already pulled out the 3 most important things out of that table. One of them is EPS, earnings per share. One is sales, are they making money? And shares outstanding. And this, I don't like to see shares outstanding going down. That means they're buying their shares back. Now, they haven't done that for 1, 2, 3, 4 years, 5 years. So they're not buying shares back anymore. And that's good. I don't like them buying their shares back. Now, if you own a whole bunch of Oracle, you do want them to buy the shares back. So, Kirk's saying Oracle is the one who bought TikTok. So that's good news. Is it good news? I don't know. Is that going to make them money or not? I don't know. It says the corporate news is good. Now has TikTok. So Oracle bought TikTok. We'll see. All right. So their sales in billions have gone up. So they're making money. You're buying into a company that's making money. All right. Their earnings per share is going up. And that's nice to see because they're not inflating the earnings per share by buying back their shares. And those of you who've been in my class for a while know that that's kind of a little irritation for me. I hate to see earnings per share go up, sales flat, and then outstanding shares going down. That means that they're buying their shares back. So of course, if their sales aren't going up and their earnings per shares are going up, because a lot of retail traders, that's the only number they look at. Oh, their earnings per share are going up. Oh, look, they're at 4.34 and they were at 3. Oh, that's great. Let's go buy some Oracle. Wait a second. If they're buying their shares back and their sales are going down, of course their earnings per share are going up, right? Because they're buying their shares back. They have fewer and fewer shares to trade, so that makes their earnings per share go up. So it's a misnomer. So don't look at the earnings per share by itself. You have to see if sales are going up and if the shares outstanding are going down or up or staying flat. If the earnings per share are going flat, or the shares outstanding are flat like they are on Oracle, and their earnings per share are going up and their sales are going up, that's a good company. All right, that's a good company. So we like Oracle, and they're way down. They're very depressed right now. So now would be a very good time to buy some Oracle. Okay, and you can see that because it's below. Let's again get rid of all the drawing tools. It's below the 200 period moving average. Now you could buy this little blue light. This little blue dot here is coming in from the bulls and bears indicator, which comes with track and trade. But when that little blue light crosses right there underneath the 100 is a little bit more aggressive, but under the 200, those are buy signals. Okay. Now, remember, when we go into a stock market, we don't all go in at once. We don't just say, okay, I got $50,000 I'm going to put into Oracle. My very first buy signal right here. I'm going to put all 50,000 right there. No, we don't do that. All right. When we get a signal underneath the 200 period moving average, underneath the 100 period moving average, we go in slow. Why? Because we might get a second opportunity to put a little bit more in at a lower price, and then third opportunity to put a little bit more in at a lower price. So we go in slowly just in case we get another buy signal, because nobody knows what the market's going to do. We don't know how far down it's going to go. We just know that anything under the 200 period moving average is a good place to buy, and we do that at the little crossover of these blue lights. All right. So these little blue lights are called the parabolic SAR. Now, this is kind of a modified version because it's attached to the bulls and bears. We call it the blue light system. And it's a mathematically calculated trend line. That's all it is, just a mathematically calculated trend line. And we've talked about trend lines in our class, so you know what trend lines are. And you can see there's one up for every down, right? One up for every down. So markets go through waves, one up for every down. There's one up for every down. Now, sometimes they get a little screwy, and there's not one up for every down. But so you can see right here, there's one up for every down. And so when it crosses, now we got three downs. Look at that. We got one down here. We got 2, 3. We're going down into the third standard deviation off the top. So that's 3 drives down. But now we're down to 2 standard deviations off the bottom. Can it go to a third standard deviation off the bottom? Sure, it certainly can. It's just that the odds of that happening are really, really low. So we start putting in our money at these low points down here in anticipation of a continuation of an uptrend and the market turning around and buying low, selling high. Now, who's going to be buying with us down here? Mostly not retail traders, because they don't buy low, they sell high. They buy high and try and sell higher. Actually, what they do is they buy high and they don't even sell higher. In fact, let's go over and talk about that for just 1 minute, because I have that little slide right here for you, right? This is what retail traders do. Here's my, where did it go? This is the one I had pulled up for you. And now I want to show you the other one, so I lost it. I want the little triangle. There it is, right here. All right, pyramid trading. Don't be dumb. Be smart. Don't be dumb. Be smart. The difference between traders who survive long-term and those who blow up usually come down to how they build their positions. All right, so this is what we're talking about. We're over here talking about how you're going to build your positions in Oracle. So markets move up and down. That's a fact. What matters is not predicting the move, but deciding when you add risk. Most people get this backwards. Dollar cost averaging simply means entering or exiting a position in pieces instead of all at once. It reduces emotion, but only if it's used correctly. Used the wrong way, it magnifies risk. All right, so we don't want to magnify risk. Professional smart money buys when prices fall. This lowers their average cost and creates a wide, stable base. As prices eventually rise, they sell into strength. Buy low, sell high. Simple concept, simple process, hard to do. Retail traders, dumb money, do the opposite. They feel safest when prices are going up. They add more as markets rise, building a small base with a heavy top. The worst price carries the most risk. All right? The worst prices carry the most risk. One sharp pullback wipes them out. So if you look at this right here, this is an example of that. If you dollar cost average down, buy low, sell high, buy on the way down, it builds you a nice big solid foundation on your portfolio. If you start to buy on the way up, which is what most traders do, most retail traders, they go through and they start building an upside down pyramid. Worst thing you can do. That's the dumb money. Don't be dumb. Be smart. Now, there's sometimes when it's okay to buy on the way up a little bit, but you don't want to be buying way up into the top upper region of these markets when they're up in here. This is a really dumb place to be buying into this market because you're building an upside down pyramid. All right. You want to build your strong base pyramid down here. Who does this? Professionals, smart money. They'll start buying when it's down here. You watch this market, they'll start to buy down here. And usually what happens is they'll go through what we call the accumulation stage. And I've got this little picture for you here. I pulled it up a million times for those of you who are part of this class. This is your picture. This is what they do. Okay, it's just a model, but it's a model of what the big banks and hedge funds do. And those are the ones we follow. So when you look at Oracle, you can see, let's pull Oracle here a little bit. Just I'm going to shrink it down, and I'm going to get rid, delete all drawings. And I just want to show you, this is what Oracle does, and this is my little drawing. Look at this. I didn't draw this picture because that's what Oracle did. We drew this picture 50 years ago, and look at Oracle. Did exactly what's in the picture. Crazy, right? So it goes through what we call the accumulation stage right here. That's this section right here. And then the market went up through the reaccumulation and distribution stages. This is the distribution, all right? So the market comes up through here. Why is it distribution? Well, because the smart money, they bought down here on the way down. And then when the market goes up, who's buying? Retail traders, right? Retail traders, they buy all the way up the uptrend. They're causing this to happen. They buy all the way up that big green uptrend. We buy. Well, in the stock market, for every buyer, there's got to be a seller. So if they're selling to you, I mean, if you're buying, who's selling? It's the smart money. It's the guys who went through the accumulation stage down here, bought on the way down through the red zones. They bought all those, and then they sell high. Buy low, sell high. So they dollar cost average down, bringing their average price down. And then when the market starts to go up, they start to sell out as they go up. That's why markets turn around and fall back down again, because once they get up there, they don't have any money left, and they're not going to buy high. So the only people up there that's willing to buy high are the retail traders, but yet there's nobody up there to sell to them because they sold out all the way up the trend. So when it gets up to the top of the trend, they don't have any shares left. They've made all their money. Now what do? They pull the rug out from under it, all their support, and what happens? The market starts to flush down, and who's selling out all the way down here? Retail traders. They're gonna like, when are they gonna yell uncle? Oh, uncle, I can't do it any longer. They just sell all the way down the trend, right? Get rid of all their shares that they bought all the way up to the top. So they lose money all the way down. And of course, who's buying it all the way down under here? The big banks and hedge funds again. They go through another reaccumulation stage down here, and then that's how it works. So now this chart moves over here. Our model comes over here. We're going to go like this. And so what you're going to see now, I'll bet you anything. What we're going to see is we're going to see this model happen one more time right here. It's going to come in here. We'll go through an accumulation stage. I don't know how big that accumulation stage is going to be, but you watch. It's going to go through an accumulation stage, and it'll break out. It'll false, fake breakdown, and then it'll start to go once again, just like that. Just like that. And it'll go up through those 3 standard deviations, just like usual. 1, 2, 3. And is it going to do it exactly? I don't know. I doubt it. It'll be something close after the fact. You'll look at it and it'll look just like this again. All right. Because that's what's happened over and over and over and over again. You can go back and look in time. Track and Trade lets you back this thing up. You can go back and look at over and over. And charts are doing it all over. We're going to go look at some other charts. You're going to see the exact same thing. Okay. But that's how you do it. So this thing's coming down underneath these 2 standard deviations. This is where you want to start buying into these markets. And that's the important place. And the best place to be buying, in my opinion, is when it crosses those little blue dots. Just wait for it to cross the little blue dots and then buy in at those locations right there. That's a good place to buy in, and then anticipate. And it might, it might do a little bit of this, but that's okay. If you got a little bit more money, when it pops down a little bit lower, you can buy some more. This is a good company. You're not going to be hurt by buying this company unless, something terribly wrong goes. And if something terribly wrong goes, it's probably not going to matter what company you own, right? So terribly wrong is something that you can prepare for, and we'll talk about that in an upcoming class. We're going to show you how to take care of terribly wrong. Okay, so that's what happens. And then, of course, we don't know how long it's going to be down here in the accumulation stage. They'll run it down there in the accumulation stage until until they've accumulated enough shares to pop it and run it and start selling out all their positions. They're in control. Big banks and hedge funds are in control. John says the accumulation and distribution method is so important to understand. As Lan says, you need to change the ways we as retail traders buy and sell. It's all a mind shift, isn't it, John? It's just the way that your brain works, and you have to think about doing things basically the opposite. You know, if 80% of retail traders lose money, don't do what 80% of retail traders do. I mean, that's kind of logical, right? And 80% of retail traders buy all the way up a big green uptrend. That's what they do. That's how come they lose. So John's absolutely right. We got to just change our minds and think in a different way. We got to think like the big hedge funds and the banks, and that's what I'm trying to teach you how to do. Think like an entrepreneur. All right, so we beat Oracle to death. Now we know what the pattern is that we're looking for. We're going to right-click on the chart, and I'm going to say, save these settings and apply them to all my open charts, to all settings, to all charts. Okay, so now all of our charts that we've got in here are going to look like that. So now we're going to go back up to AXP, American Express. Now, American Express, been a crazy market. Look at where it's at. It's way up here above the 100% moving average. It hasn't come and dipped down here yet, has it? So do we want to be buying American Express up here? Probably not. Do you have some American Express? If you do, well, if you don't want to sell it, because if you sell it, you're going to have a taxable event. You're like, well, I'm holding it for 30 years, Lan. Okay, well, AXP, American Express, if you're holding it and you don't want to sell it because you don't want a taxable event, then you got to protect yourself to the downside, because this thing is nasty high right now. All right, look how many runs it's had. 1 big run, 2 big runs, 3 big runs, 4 big runs, 5 big runs. That's amazing, you know. But of course, you know, the market's been going crazy too. I mean, this has been one of the biggest runs in U.S. history, right? I mean, it's Trump train 2. We're on Trump train 2. We actually had 3 Trump trains. We had Trump train 1 when he first got elected. Boom, the market went up like nobody's ever seen. And then we had COVID, which dropped like a rock. And then we had Trump train 2, which was the recovery of COVID, so that when he left office, the market was actually higher than it was before he left. So that was Trump train 2. And then he gets reelected, and now we're on Trump train 3. So this is like crazy, crazy, crazy market. So, but what goes up must come down. Not always, but always. In the stock market, it's pretty true. What goes up must come down, because we have one up for every down. That's how it works, right? So you're saying, well, Lan, I'm seeing the one up here, the one down here, the one up here, the one down here. I'm seeing the one up here, the one down here, the one up here, the one down here, the one up here, the one down here. And now we're going to another up. That's true. Are we going to make a higher high and a higher low? Remember, we talked about that in class 2. And in class 1, we talked about higher highs and higher lows. We're going to talk more in greater length of all this technical analysis stuff in the upcoming class. I mentioned that to you. We're going to go into it in great detail. But this is starting to get up here. But you got to also remember that on longer term charts, see, this is a daily chart. So this is just a small chart. This is one up right here. Oh, now I just blew your mind, didn't I? This is one up. And now we're looking for the one down. Okay. So if we go out here and we go to a weekly chart, you can see a different model. I turn on that Fibonacci. So now we see a different model, right? 1 up, 2 up, 3 up, 4 up, or this is a retracement, so we start over. So once we get a 50% retracement, we start over. So now we're on 1 up, 2 up. Is it going to go to a third up, or is it going to get a retracement here? This one only went up 2 standard deviations before it came back down to the mean. This one, 1 standard deviation, 2 standard deviations. Is it going to go and then come back down to the mean here, or is it going to go up to the 3rd standard deviation? We don't know. But I really don't want to be a buyer up in here right now. This is really kind of a particularly scary place to be a buyer. We might get that 1 standard deviation if we take our little Fibonacci ruler and put it in there. That would bring us back down into this region here, right? Possibly. Let's look at where it did it last time. Get rid of all your drawing tools. Come in here and do it. What did it do last time? Last time it ran up like that. Go up to the top. It came right back down dead center of that 1 standard deviation. How about that? You look down here on a smaller time frame, it had a kind of a rough time back here. American Express just went sideways for years, didn't it, on the weekly chart? Kind of a real rough market. But if you go back a little farther, you say, okay, it went from this low to this high, all the way back down into the 1 standard deviation right here, just like a train on rails. Then it went through this big, long accumulation stage, and then it took off and went to a market, went to the moon. So it's done that. Here's another accumulation stage down here just before it took off and went to the moon. And you can go back and look. Now, this is a weekly chart, meaning that each price bar represents 1 week. Okay. So it depends on how long you want to be reading your charts. And then, of course, we can go out to a monthly chart where one price bar represents an entire month's time frame. And you can see basically the same pattern. As the market comes through, it keeps going back to these 1 standard deviations on every time frame, on every time level. All right. Now we're into the Trump train. So Trump train 1. Now we're in Trump train 2. How high is that thing going to go before it comes back to a standard deviation? It's done it every single time. Clear back. You can go back as far as you want. And it's done it every single time. It goes to 1 standard deviation. Now we're in the Trump train. Now what are we going to do? Okay. We're probably going to get a pullback. And it doesn't mean that Trump did something wrong. We just call it the Trump train because he's president. We had a Biden train too. Don't want to leave out the Biden train. This was a Biden train right here. And it's controlled a lot more, not as much by the president. President Trump has a lot to do with this one with his Trump trains, because he really does change the economy. Most presidents don't do much with the economy. They just get in there, basically placeholders. Right? They don't do much. Trump actually does stuff. He goes out and sells shit. He sells America to the world. So, most presidents just go in there and they let the Fed do everything. So this was a lot of quantitative easing that we did during this time frame, during the Biden Trump train, or Biden Trump train, the Biden train. All right. So we had one of those too. And it flushes, and that's just what markets do. And you can't really blame it as much on the president, or give presidents as much credit as they get for the economy. Mostly it's the Fed that has control of everything. The Fed does what the Fed wants to do, and you found that out with Trump. Trump wants Fed to change things, and they don't do it. They don't do what the president says. They do what they want to do, and they drive most of this. All right. So we come back down to the daily chart, and we look at the daily chart because it affects us most, because we're emotional traders and we're not trading. Well, most of us aren't trading on a 50-year timeline. We're trading on a year-to-year timeline, right? So this is the daily chart, is the one we look at most often. So now what are we going to do here? This has come down to the 1 standard deviation right here, the 100 period moving average. And it dipped below it, and we got a little blue light, but the little blue light wasn't below even the 100 period moving average. And we talk about that in the article in Pitt News Magazine, the value, or how valuable is the levels. And I think let's pull that up and I'll show you on Pitt News Magazine. In the image, we've got them ranked. All right. So right here, we say this is 1, 2, and 3. So you got decision point 1, which is the best. You got decision point 2, which is a strong opportunity. And you got decision point 3, which is down here. Right here, decision point 3 is just a momentary or a momentum entry. This is the most common setup, decision point 3. All right. So when we go over to decision point 3, this would be considered probably a decision point 3. All right. It's a blue light crossover, and it's above the 100 period moving average. So it's still way up here. Not real thrilled about getting into that one. Okay. It's just a momentum move. If it come down into the 2 down here, we'd be a little bit more likely to want to maybe add a little bit in. But if it comes down into the 3, now the problem is, as you can see, if you wait for it to come all the way below the number 2, you might not get in for a whole year. You might have to wait the entire cycle to get back in. So where's our little cycle? Where'd our little cycle go? Lan, you lost your cycle. Okay, well, let's pull it up again. Here's the cycle. So if you lose your little cycle, if you're waiting for it to drop all the way back below the 200 period moving average, then you might be waiting a long time, because that means it's going to drop all the way back down into this region here, right? And it's already been in that region down here, and now the 200 period moving average is going to be moving up, and you're going to miss all this through here if you don't get it down in here. So you have to wait and wait and wait for it to cross below the 200 period moving average before you can get in on the overall longer term cycle. But right here, this is kind of a rough spot to be getting into, because it's right up here at the very top. This is the pattern we're looking at right here, right? So I'm not real thrilled about buying into AXP up here. It doesn't mean it can't break and go up higher. It certainly can. But this is, remember, we're all working with probabilities. And so the probabilities right now are telling us that this is a left shoulder, this is a little left shoulder, this is a neckline, this right up in here, we got kind of a little double top up in here. We'll call this the head. And then this is your neckline. And then this is coming in making the right shoulder. Now, the question is that right shoulder going to go up and break across that top and make new highs? If it is, well, it's going to be an amazing market. But usually what happens, and you can see it hasn't happened, it keeps going up and breaking new highs, going down, breaking new highs, going up, breaking new highs. So if you think that market is going to go up, break a new high, and then just keep on going, you could buy right there. That would be a buy. It would be a third-rate buy signal, or a first-rate buy signal right there. It's actually the other way around. The best buy signals are ones, right? The second best are twos, and the third best are three. So if I say it's a third-rate buy signal, that would be a three. But threes are not, threes are. This is not a. This is a third-rate buy signal, I guess. So my bet, and I'm just a betting man, so we'll probably get something like this. And if it doesn't happen here, we'll just have to move that whole thing. We'll just come all over, and we'll just do it again, just like that. And then we'll have another head, and we'll look for the next right shoulder to come down off of. Come down off of here. So I'm not real excited about AXP. It's way up there. If you wanted to buy into this, you would need to definitely get some hedges on, all right, which means buy some put options. Now, this is way beyond the scope of this class. We're going to talk about this in the future, but you could come in here and you could come in and you could buy yourself. You say, well, I think that's a great place to buy into AXP. Well, you better have a hedge. So you're going to come into your trading platform. You're going to come in here. You're going to buy 100 of these, and you hit buy. There's $36,000 into AXP at the very top of the market. And we're going to come in, and if we're going to do that, we better damn well have some insurance. All right. You don't want to drive a $36,000 car without any insurance. So you're going to come in here and you're going to buy a put. Okay. You drop that right in there on the screen. We're going to put that right in there. And that's $1,600. It's going to cost you $1,600 of insurance for the next 100 days to protect that position in case it falls. And then it won't lose anything below what's underneath that green line right there. You have a little bit of a distance between there. See, that's your little bit of a margin right in there between here. Okay, so that's the spread. That's what we call that between there. But that's the I don't like to call it a spread. That's a financial term. I like to call it your deductible, right? It's your deductible. It's like, because you're buying insurance, and so how much are you going to have to pay before the insurance kicks in? Well, you're going to have to pay between where you got in and where you put the order. So that's your deductible is right there. Okay, so there you go. So that's your deductible. So you can pay $1,600 for that put option, which will protect you in case that market flushes out. And then you won't lose anything but the deductible. Now, it's a little bit more complicated than that because we got delta, and delta's only at 0.50. And if I don't throw that out there, the options guys are going to go, it's not exactly 100% land, not until the purple line. And that's true. It's called convexity. Again, we'll get into that in future class. We don't need to worry about that right now. And so just showing you how this is working. So what I'm trying to say is I would not go out and buy a whole bunch of these things that we're talking about until you take the rest of my classes, okay? Because we're midstream and we're showing you all this neat stuff, and people get excited and they want to run out. And Kurt calls it Trump's. It's not a train. Biden's is the Amtrak. That's perfect. I love it. All right. So don't go and buy all this stuff until you take the rest of my class, because we're midstream learning how to do this stuff, and I've got still more stuff to teach you. So don't just say, oh, Land told me all about this one, I'm going to run out and buy that stock. All right. Let's go ahead and see if we can get that to fill. Let's go ahead and we'll edit that order. It's in here. Let's just see if we can mark it into it. If they'll give it to us, we'll take it right now. If not, oh yeah, it's there. All right. So we put that trade on. There we go. Okay. So we're going to come in here to Costco. So here's Costco. Oh, wow. Look at what Costco did. Costco did the thing, went all the way up through the crazy Costco. Look at this. Wow. Up, down, up, all the way down. Oh, yeah. This is a crazy market. Look at the head and shoulders on that thing. Left, head, neckline. Oh, my gosh. What an ugly, ugly market. That's hard to trade, isn't it? That's a wild bugger. So anyway, if you take your Fibonacci ruler and you measure those standard deviations, it comes right back down into the standard deviation. This one, of course, came all the way back down to 100, went all the way back up, came all the way back down to 78, and then it went back up. So now it's coming down. So now we're getting the downs. All right. So how far down is it going to go? Well, it already came all the way down. Came all the way down here. Where did it cross back above the standard deviation? Right there. You can see the MACD. Now, it had a little bit right here, a little jig and a little jog, but for the most part, it's been in a downtrend this whole time. So all the way down, all the way down. Where did it cross? Right there. Okay, so now we're back above. That's the new standard deviation line right in here. And so now we're coming back up. So this thing's crazy. We might get a nice little pullback and another opportunity to get in. Who knows? Nobody knows. We're just going to wait and see because we kind of missed it now. We don't want to buy right now, right? Don't want to buy right now because if you go off the top and all the way to the bottom, look where it's at. It's right in the dead center of the standard deviation to the downside, which could be another down flush. And if it does, that might be a good time to buy. We'd like to see this thing pull back down into this region here, at least test that previous low right there. So if it came down there, we'd watch for a nice little blue cross over that blue dot. And that's where we'd add a little bit in right down here. Let's see if it'll come down here. Give us a blue dot. It's got to cross this blue dot first. So we may even get another up. Who knows? Nobody knows. You just have to watch and see, wait for the signals to come in. If you don't get one, if you don't get a little blue dot crossover underneath the 100-period moving average or below the 200-period moving average, you just don't buy. You go to another chart and say, well, let's go see if there's an opportunity on JP Morgan Chase. Nope. JP Morgan Chase, last time we had a big, huge accumulation stage was back here. Now it's going up like crazy. Now we got this one here. Came back down. That would be a same as Costco, right? Not Costco, same as AXP, American Express. It's giving you a little buy signal, but it's up here above the 100-period moving average. So you can see there's a little buy signal there. There's one there. There's one there. There's one there. There's one kind of there. And then there's one there. There's one there. There's one there. Now we're getting one here. Now, at least this one dipped below the 100-period moving average. JP Morgan Chase making money. If you want to buy up here, you can. Because oftentimes markets will go through what we call a reaccumulation stage where they'll go up like that. And then the market's too strong. It can't dip. See, it should have dipped right there. And it didn't. So it's going through what we call a reaccumulation stage where it's coming through like this. And it's trying its hardest to break out and start to create another reaccumulation stage. And it might have done it right there. That might just be it. And we start seeing another rally up out of this thing. And it may start going like this. We may see it come up, break new highs, come down. Actually, usually, yeah, that's usually where it comes to. And then we'll start seeing it go, make these little, maybe some little more shallow follow-ups like that. Okay. So all we can do is speculate. We can see right here, we're below the standard deviation right down here, MACD, see that? But it dropped below here, it dropped below here. So it looks like to me, if you look at the pattern here, this is lower than this one. So even though it was higher in the market, right here, see this high right here? In the market, this is lower than this one, and this one's higher than this one. That's why it's called the MACD, convergence divergence, all right? Moving averages are just what we're doing here. That's just the moving averages. But the CD of MACD is convergence and divergence. And what you start to see is you see divergence in the indicator, meaning that we see a high here and a lower high here. See how this is lower high, then this one is a higher high? Well, if this is high here, and see how this is higher than this low, so you draw a trend line from this one to this one, the market is going up, but the indicator is going down. That shows weakness, all right? That's called the convergence divergence. That's the convergence divergence part of the moving average MACD, all right? So then we're seeing that same thing on a longer term basis. We're seeing this high, and then we're seeing it go all the way up to here, but yet here to here is actually lower. It's losing strength is what that's showing. That's showing that it's losing strength. And so now we're down here, dipping down into the dippity-doo-dah day down here. And it looks like to me it wants to flush one more time. Maybe we'll get an opportunity to get into JP Morgan Chase underneath the green line, underneath the 200-period moving average. That would be nice. That would be a good place to be buying down into JP Morgan Chase. We need it to pull back a little bit. And if we take our Fibonacci ruler and run it all the way up through that Trump train, all the way up here, it's saying that we could see this thing back down into the one standard deviation and be clear back here. I don't know. Some of these markets are not coming back that far. So we bring it up to where the top of the third drive is, right up here, right? Where it goes through the reaccumulation. And now you can say, well, it's already pulled back into that one standard deviation. In fact, it's way back down right now into that third standard deviation down here, a second standard deviation down here underneath. and now it's starting to rally back up. So this is a real unknown right here. And if you don't know what to do, don't do anything. Only do the ones where you really know what to do. They're obvious, all right? The obvious ones. So here's Eli Lilly. Again, coming down off the top, down underneath the 3 drive pattern. So we got a nice little drive 1, drive 2, drive 3. Now it turned around, drive 1, drive 2, drive 3. Now we're getting this little topping pattern right in here. This little wedge pattern, right? So we take this, we say, well, it's making this little wedge pattern up in here. And it's starting to try to break out that wedge pattern to the downside, isn't it? So it looks like to me, it wants to come back down into this level here. And you're sitting here going, Lan, what does this have to do with the price of rice in China? Why does the market do all this? Well, markets are traded more than they're the movement of a market price is because of traders. You got long-term investors that just hold for a long period of time. They just put money in and they don't ever take it out. They just leave it. So there's a big chunk of money that just sits there all the time. That money doesn't move the market because it's not going in and out of the market. So it doesn't move the market. On top of that, you've got the traders. So you got investors and you've got traders. And you have to break those two into 2 categories. You can got investors that just hold forever. You got traders that move in and out of the market, buy low, sell high, make money, right? You got to sell. If you buy something, you want to go buy some cans of beans, you got to sell what you bought so that you can make some money and go buy your can of beans. So there's groups of people who have buy and sell. And then there's the smaller group up here that really buy and sell a lot, usually day traders, right? Short-term traders. So you got short-term traders, you got normal traders, and then you got investors. And you have to decide what pattern you're in, okay? You don't say, well, I'm a trader, and then suddenly it turned bad, so, oh, now I'm an investor. A lot of people do that. Are you a trader or an investor? Have your investing money, have your trading money. And you trade, buy low, sell high, and get out when you're wrong, and the market starts to go against you, take your profits, because you're a trader. If you want to be an investor, well, you're probably not going to invest in the same things you're going to trade. So don't turn a trade into an investment because you're not going to hang on to Eli Lilly forever because Eli Lilly is very volatile. For your investing, you want those to be index funds, right? You want those to be long-term diversified funds. They're already diversified for you. S&P 500, the Dow, the NASDAQ, even some specialty diversified portfolios like maybe MAGS, which has the Magnificent Seven in it. Those are your investments, okay? And you might hold on to those for a long time. But Eli Lilly, unless it's in one of those, you're not going to be, if you're going to trade it. Be a trader. Buy low, sell high to make money. Go buy beans, all right? That's what you're doing with this one. You're going to get taxed on this money if it's in a taxable account, or if you're trying to grow your own money in a tax-deferred account, that's okay too. But the point is you're being a trader. So be a trader. Be an investor. This is investing money. This is trading money. You want to be a day trader? That's fine too. Then we go do some day trading. That's fun too. But this is just trading, all right? So we're going to talk about trading. So you don't hang on to it forever if you're a trader. You buy low, sell high, make money. Go buy it, go spend it, go make things, go buy things. Or be a trader, and when you make a profit, if you don't need it, take it and put it down in an investment. Oh, I made a whole bunch of money on Eli Lilly. All right, I traded it. Now I'm going to take that money and I'm going to put it over into the S&P as part of my investment. And that's how you're going to grow your portfolio. You don't grow your portfolio in Eli Lilly. No, Eli Lilly is an income source. You trade Eli Lilly, make the profit, put it into the S&P, go make some more. Go over and trade Oracle, make some money, put it in the S&P. Go make some Wells Fargo, make some money, go put it in the S&P. So you have your investments, and that's how you grow your investments, all right, by trading. But we don't say, well, my Eli Lilly, I'm just going to buy it and hold on forever. No, that's not what you do. Don't do that. Okay, don't do that. So now we're going to come in and we're going to look for this market to rebound, come back down. Is it going to? I don't know. I think it will. It usually does. Doesn't mean it's going to. It might never do it. Might just keep going up forever. Ever. But more than likely, we'll see this thing back down here, testing at least the first standard deviation, which is around 38.2, right? Maybe it'll come down into the sweet spot, down into the 1 standard deviation, where it likes to stay 62% of the time anyway. And then we're going to see it. Maybe it'll even break down into the 3rd standard deviation and the 4th standard deviation down underneath. Well, we can go back over to our charts here, if I could find them again. Where did they go land? Oh, you didn't close it, did you? No, you couldn't have closed it. No, there it is. I found it. Got so many windows on my screen. All right, so we're going to come back over into this one, and we're going to pull up. What was it we were looking at? I can't even remember. Lily, LLY. Oh my goodness, my brain. LLY. So we're going to pull up LLY over here in this little program, and we're going to slide down, and we're going to look at this stuff. Oh, Lily, making money. Look at that. That's a company making money. Earnings per share way up. Flat shares outstanding. Fantastic. This is a fantastic company to be in. We want to own this. Boy, we want to buy this. We want to trade this. All right. But we don't want to buy it right now. Why? Because it's way high. It's way up in the top of the pattern. We don't want to buy into this market, right? It's way up here. It's right here. Look. Where's the pattern? Where's the map? Right there. So it went through the accumulation stage right here, and it went up through this, little patterns here, right? And then it went way up here into this topping formation up in here, just like that, right there. Where are we at? Where are we at in the map? Where's it? What's it going to probably do? Probably going to come down, right? It's probably going to come down in here. And then it's going to go sideways, and we're going to be able to buy a whole bunch down in here in the red zone. And then that's where we're going to buy and go be rich beyond our wildest dreams, right? Just now, what if it doesn't do this pattern? Does every market do this pattern? No, of course not. Just the ones that are controlled by big banks and hedge funds do this. Why do they do it? Well, because that's how the big banks and hedge funds trade. And that's all computerized in a computer. You don't think there's some guy in a big hedge fund out there pushing, clicking little mouse buttons, do you? No, of course not. It's all programmed, and that's why it works. That's why it does it, because you got all these banks and hedge funds, and they're out here trading, making money, and then they take that and invest it. Then they trade, make money, take it out and invest it. Trade, make money, take it out and invest it. All right. And then if they need to trade some, they can pull some out of their investments and go trade with it, and then put it back in. And they call it rolling their money in and out of different markets. Okay. So you can roll in and out as markets are moving through price and time. And they use computers to do it. All right. Big computers. Oh, AI is going to take over and destroy the financial markets. No, it's not. It's not. I have no faith that AI is going to destroy the stock market. Why? Because the stock market's been being traded by computers for 40 years. And the markets can only do three things. They go up, they go down, they go sideways. So can you get an AI system to trade for you? Yeah, absolutely. We've had them for 40 years. But it's not AI as in artificial intelligence. It's systematic decision-making processes programmed into the computers to do all this stuff. So if you get an AI to do it, well, what's an AI going to do? Well, they're going to do basically the same thing that we've been doing for 40 years with computers in the stock market. They're going to buy low, sell high. So they're not going to be anything different than what we've already got. And what we've already got hasn't driven the market out of business. What we've basically done is we've made the market do things over and over and over in recurring price patterns because we've computerized them. It makes it easier to trade, not harder, right? If a computer is programmed to make the market do exactly the same thing every single time, it suddenly becomes easy to draw a map like this and say, well, heck, the market does the same thing over and over because that's how they programmed it to do it. And you're like, well, I'm going to do just the opposite of what the computer programming does with my AI system, and we're going to capitalize on that. Doesn't work that way. Contrarian traders aren't, contrarian is contrarian to the retail trader, not contrarian to the big markets, not to the big computer systems. Can't be contrarian to the big computer systems. They have all the money in the world. They control these markets, all right? They make them go up and down. They make them do whatever they want. They can, all right? So these big computers are the ones that are trading like this. And if the AI system comes in and says, well, I'm going to trade and I'm going to be better than the big computers that are already here. No, it's not. It's just going to join in on the band, right? This is a Me Too market. Market starts to go up. Me too. Me too. I'm going to Me Too it, right? Me Too markets. I don't think AI is going to destroy the stock market. Now, you might have AIs that have trading systems, might make it easier, more accessible to the common Joe that can go out there and get an AI system to develop a trading strategy for them and the trading strategy that they want to trade. But are they profitable right now? They run all of the AI systems. I've seen a bunch of guys modeling them and trying to get the AI systems to run their models, run their trading strategies for them, or develop their own trading strategies. And there's only been one that's made any money. All the rest of them lost money. But that's pretty typical of computer systems. Most computer systems, if they're selling it to you, you can go out and buy all kinds of black box computer systems. I can show you, there's more of them out there than you can shake a stick at. I can show you so many black box systems, and I can guarantee you, if they're selling it to you, it doesn't work. If they're selling it to you, it doesn't work. Because if it worked, they wouldn't need to sell it to you. They would take cans of spray paint and they would spray paint their windows black, and they'd pull down the curtains and they'd turn off all the lights, and they'd sit there and they would run it themselves, because they could be rich beyond their wildest dreams running a system that worked as well as they claim it does by selling it to you. The reason they're selling it to you is because it doesn't work. Now, does it work sometimes? Yeah, probably works sometimes. Just like any trading system. Any trading system works sometimes because you're playing the odds. So I believe that it's always better to use all the computer systems like we're doing to help us make our trading decisions, but realize that there's emotion involved in everything we do. All right. The one thing that is very hard to take into consideration is the human aspect. And you say, well, I'm going to take the human aspect out of the market. It's a good idea. Do that if you can. But I think the human aspect is necessary in many cases, because you want to be the discerning mind that decides whether the market's going to be good to trade or not. Well, I'm going to let the AI do that. Okay, well, if the AI can do it, then great. I'm just saying right now, I don't think it's going to kill the stock market. It's not going to take the market away from you. They're not going to corner the market because you have AI. But can you use AI to trade? Absolutely. I use it all the time. I upload these charts to AI and ask Grok's opinion. Hey, where do you think this is going? But I've been doing this long enough. I am an AI. I'm half AI. All right. I'm an alien, me and Elon Musk. So I've been looking at these charts for 40 years, and I see that pattern reoccur so many times that I don't need to have an AI tell me that. I can look at the chart and see it. Now, the AI doesn't know if the market's going to go up or down. All it can do is give you the probabilities, just like I can do here, just like we have. What are the probabilities? Do you trust the AI to put a position on for you more than you trust yourself? Maybe. I don't know. It's going to be an interesting world that we're headed into. We're going to have to wait and see what happens. But I certainly don't believe the AI is going to destroy the financial market. And the reason is because we've already had computers trading for 40 years, and it hasn't done that. And they've been saying that forever. Computers are going to just take over the world. It's going to destroy the financial markets. There's not going to be a stock market. You know how long I've been hearing that? 40 years I've been hearing people say that. Back when we started trading TRS-80s on the stock market. That's going to destroy the stock market. It hasn't done it yet. All it's done is been better and better and better, and easier, actually easier and easier to discern what's happening in the stock market because of all this stuff. Now, of course, you got all the fundamental stuff that takes into consideration too. This is all technical stuff, but the fundamental stuff, by the time we hear about the fundamental stuff, all the news and the good reports and bad reports, it's already built into the price that we're looking at. So that's why we look at price. We look at the price models because the news is already built into price. And by the time we hear the news, it's too late for us to take advantage of it because we're too small. We can't take advantage of all this great news unless you get the news exactly the same time as everybody else. But when do you think that happens? Never. All right. Land got off on another one of his silly tangents. Where did we get to? What were we doing here? Okay, let's go look at the next chart. Okay, so this is Eli Lilly, and we were looking down here at Eli Lilly. And I was going to go look at and we did. We were going to go look at the profit potential of Eli Lilly. Is it a good company to be in? It's absolutely a good company to be in. We just want to wait for the right opportunity to buy into it. So we're going to wait for the right opportunity because it's got all the really good fundamentals down here. These are the fundamentals that you like to look at. Is it making money? Are they buying their shares back? Is the earnings per share pumped up? Is the earnings per share pumped up because they're buying their shares back, or is it pumped up because they're earning money? You want it to be because they're earning money, not because they're buying their shares back. All right. So all we need is an opportunity to get into Eli Lilly, and there's no opportunity right now. This is way high. We need this thing to pull back. Buy low, sell high, buy down here, buy down here, buy down here, buy down here, and then watch it go to the moon. Okay. Oracle. We already talked about Oracle. We're buying Oracle. We're backing the truck up. All right. Okay, we're Wells Fargo. Wells Fargo. Did we look at Wells Fargo? Because it looks exactly like JP Morgan Chase. Almost identical, doesn't it? So we don't even need to talk about Wells Fargo because it looks exactly like JP Morgan Chase. All right, Walmart. Holy cow, look at Walmart. Now, this is one of those situations where you're like, well, man alive, when are you ever going to get into Walmart? Whew. This is one of those reaccumulation stages, isn't it? Look at this thing. It went sideways, broke out, came back into the sideways, and then went another reaccumulation right here. And then, man, it took off like a rocket ship. So what we got to do? Well, WMT. We got to come in here and we got to go WMT. What are they doing? Are they making money? Are they making money? They are making money. They're also buying their shares back, which is pumping up their earnings per share. Why are they doing that? There's many reasons why the company buys their shares back, but you've got to be careful looking at earnings per share rising like that when they're buying their shares back, because that pumps up the earnings per share. Now they've got good sales, so Walmart, good company to be in. Yeah, it's a good company to be in. You probably have some Walmart if you're in the S&P 500, the Dow, some of these, because these markets are already in all the big indexes, right? So that's Walmart. Man alive, what a market. What a market. So where's your buy signals? Right here, right here. It's above. Look at this. It went down into below this one standard deviation. Sit there and twiddled around in there. Kind of went up above it, went above it, went up above it again. And man alive, look at it. It's way up into the ones. We're going up into drive 3. Drive 1, counter trend. Drive 2, counter trend. Drive 3. You want to buy some Walmart right there? Not really. I really don't want to right now. Why? Because it's way up there above the 100, 200 period moving average. We draw our Fibonacci ruler up there. We're way up there into the third standard deviation, because this thing went into the right here. Let's put our Fibonacci ruler right here. Okay, so we're going to take our Fibonacci ruler, draw that right over the top of those red bars, just like that, because that's where MACD said that's where the standard deviation was. So if we put that right over there, just say that's where our standard deviation was. This thing left the first standard deviation, and it's all the way up here. So it's gone way up into the first standard deviation. It's gone way up into the third standard deviation. Drive 1, drive 2, drive 3. That's how we count them. Way up there. Does it mean it can't go to 4, 5, 6, 7, 8, 9, 10? No, it certainly can. Certainly can. It can go to 4, 5, 6, 7, 8, 9, 10. It's just, what are the odds? The odds are very low. So we want to look for this thing to come back and maybe give us a buy signal, give us a little blue dot. Now, the thing is, because it's gone up to 3, I want to see it come back down below the 100. That would be a lot nicer. Am I going to be buying into this one? No, I missed it. If I didn't buy it here, you just kind of watch it go. So what do? Well, you have to go watch a different stock. Now, those are our blue chips. The next one is our Mag 7s. And we're just going to go down through these really fast. Why have I got now I got AAB. I can't type AAPL. Isn't that Apple? Yeah, get rid of AAB. That's not one. Delete. Okay, there's Apple. Where's Apple? Look, it just got a buy signal right there underneath there. We might get a nice little retracement, a little bounce, and another opportunity. So wait for it to come back down, break the blue lights, create another little set of blue lights, and that's where you want to get in. Look at how this thing's already crossed out down here. Oh, so perfect, right? We got our, look at this. Drive 1, drive 2, drive 3, drive 4, drive 1, counter trend, drive 2, all the way back down under 200. Do you think it's going to come back down under the 200 period moving average? Probably not. Might come back down, might do it, right? If we go from this Fibonacci ruler to this Fibonacci ruler, the delta cone of probability came right smack dab right here. Now it's taken off and going again. I'd like to have seen it go for an accumulation stage a little bit longer. You go from the very low to the very high. Oh, drawing circles when I'm supposed to be drawing Fibonacci rulers. Come on, come on, find your tool. All the way from the bottom, all the way to the top, all the way over here. Well, the further down one is all the way here. It may come back down. Nobody knows. That's why we wait for it to break below these moving averages, and then we get our signals down there, and we can add in. We can add in a little more and add in a little bit more. Just keep adding in a little bit more, right, as it comes down. All right, we're not going to, oh my goodness, look at Amazon. Nice little run right up off that natural trend line, just like that, and flush like a toilet. What are we going to do here? What are we going to do here? Well, it's giving us an opportunity, isn't it? Giving us an opportunity. Do I need to go over and show you that Amazon's making money? No, I think we all know that these are good companies. We don't need to go to that other little program and look. Where's it at? Oh my goodness. It's sitting dead center. The cone of probability right there. Right dead center. Came right down to the bottom of the delta. Look at that. Like a train on rails. Touched it. Perfect. Buy right there. A lot of guys, myself included, will come in here and we'll put limit orders. Put a limit order at 61.8 just inside of it, just like that, so it'll touch it. Also, we'll put another limit order down here, right? We'll also put another limit order at 50%. So if the markets come down and touch these things, can't do it right now because the market's already moved, but it's going to come down and go boom, 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 and that's your 3 entries. Entry 1, entry 2, entry 3. Now, I like to do it a little fancier, right? So I'm going to exit the chart. I like to come in, and I like to come in with options, and I like to come in and I'm going to sell a put. I'll sell a put right here, and I'll sell another put right here, right? And then I'll sell another put right down here. And what does that do for me? Well, that gets me the same exact thing as putting limit orders in there. I get to own the shares here, I get to own the shares here, and I get to own the shares there if the market comes down and touches that purple line underneath those red lines. But if it doesn't, turns around and goes back up, well, then I missed my opportunity to get into my shares, but I get this money over here. I get $1,460, $1,000 here, $575 here. So I get to keep that $3,060 just for putting the orders on to say, I'll buy Amazon at this level, 100 shares of Amazon here, I'll buy 100 shares of Amazon here, and I'll buy 100 shares of Amazon here, which is what I was going to do anyway. I might as well make $3,000 putting that order in there. That's options, okay? We're going to go into that in greater detail in our classes, so stick with me. We could actually go in and put this on right now. We're going to come in here and let's see if it'll let us market order into them. Nope. Not going to let us market order into them. All right, on to the next one. All right, so we go into charts. We go down to Google. Oh, wow. Wow, wow, wow. Now, how come this doesn't have our moving averages on it? Moving averages. I thought I turned those on. So right down here, look at our moving averages all down in here. This was buy, buy, buy. Buy like crazy back in here, right? Let's turn off the auto scale. So look at this. Oh, this is where you should have been buying into Google right in here, right? Hindsight's 2020, but I'm trying to teach you hindsight. Then it's going red. That's when you want to be buyers. Down in here, look, right here, MACD. Down in here is where you want to be buyers. And then when it crosses back over, we're back up into the bull zone again. And then we come up here and what it's doing. Oh my goodness, look at how beautiful that was. Making money, making money. One, drive 2, drive 3, drive 4, drive 5. My goodness sakes. 1, 2, 3, 4, 5 drives, almost 6 drives. That's a little tiny one up there at the top. 6 drives high. So that's 3 and 3. 3 drives, this one here. That third drive didn't break as far back as we like it to, right? So we break it down into 3 drives. That market didn't come back even to 38.2, and then it started its next set of, we're going to just merge that last one as one drive. So we got drive 1, drive 2, drive 3, and now we're coming back down off of this one. Where is it going to come? Well, probably down into here at least, but we've also got to take into consideration this full drive all the way. Oh my goodness, land, you cannot choose the right tools today. Tool. From here to here. That would bring us down into 1 standard deviation on the overall longer term run down into here. So we got 2 spots. We got this one, and then we got this one. And I don't think it'll come all the way down to 78.6, but you never know. Markets, we don't know what they're going to do, right? We don't know. But when they come down, we can put our orders in there to take some positions. We want to get some orders in there. You could do it with a limit order. Come over here. Say, oh, I'm just going to come in here. Put a limit order in right there, 61.8. If it comes down there, I'm going to buy. I'm going to buy me some shares. How many? Well, however many you want with an order. If you're going to do an option, it's 100 shares. They go in increments of 100. So you come over to an option and say, well, I'm going to put an option in there. I'm going to sell a put right here at 38.2. See, that'll give you $755, and it'll give you your 100 shares right there. If it comes down there and touches this little purple line underneath that red line, you'll get your 100 shares at that price level. just like a limit order, but they're going to give you $755 to do it. If it doesn't come down, what if it turns around and goes all the way? What if it does this? It comes down here and then goes all the way up here and touches the purple line. Well, you don't get your 100 shares, but you do get your consolation prize of $755. There you go. Now, 100 shares of Google is $28,000. So if you're going to buy $28,000 worth of Google anyway, you might as well do it with an option because they're going to give you $752 to do it with. You can't buy with an option anything less than 100 shares. That's just not the way it works. 100 shares is the smallest increment. I wish they had 50 share options. That would be really cool. Allows more people with smaller accounts to trade options. But they don't. So you have to go find markets with smaller share prices. Go find a market that's got $29 shares. And then there you go. Solve the problem. Okay, so let's come in here. Let's go to Meta real quick. Oh my gosh, look at Meta. Just like a train on rails. This little model, just like we showed you, came right up here. 1, 2, 3. A little topping formation, lower highs, down it came, right down to 61.8. Right back into the model, just like I told you it likes to do, just like we know that it does. It's just like can't make it any clearer than that. How much clearer can we make it? That's what markets do, over and over and over and over and over and over. Where are we at on this one? Now we're starting to go through the accumulation stage, getting ready to rally and bounce again. Where's our moving averages? Come on, moving averages. Oh, that's why, because that was the other portfolio. Here, we'll save and apply this to all chat. There we go. Now they're on all of them. So now we got this down here. We're getting ready to rock and roll to the next level up, right? Next level up. We take our Fibonacci ruler, start from here and say, well, where's it going to go? Well, we don't know. Up in here somewhere. But it's probably coming down here and going up through the multi-drive pattern. So there's drive 1, or this could be the accumulation stage right here. This is probably accumulation. And then they'll pop it right here. This is the pop 1. Pop 1. It looks like they're going to pop it 2. Maybe we'll get pop 3. I don't know. Nobody knows. But it's down here where we're getting a little pullback on that blue light. It broke the blue lights to the downside. Could it just flush out and go down? Yeah, it could. But this is also a buying zone down in here when it crosses those blue lights, right? So you could buy a little bit right in here in anticipation of a rally. If we come over here, go Meta, META, you know what it's going to show us. We already know what it's going to show us. It's going to show us Meta's making money. Look at them making money. Holy cow, they make money. Buying some shares back? They are a little bit, not too bad. Their earnings per share went down a little bit. Earnings per share up here. But man, look at them making money. They're making money. All right. We want to be in that company. So that would be a good place to buy a little bit, right? Buy a little bit. Buy 1 share. Whatever your portfolio can afford, be a small purchase right now. Get a little in there. Get a little in there. All right. Let's go to the next one. Microsoft. Same thing. Same pattern. I don't have to draw it for you. You see it. It's right there. It's right here. It's right here. Right here. What do you want to do? What do you want to do? It's below the 200. When that crosses that blue light, that's probably going to be a good place to buy some. You could even jump in early. This is called catching a falling knife. Not really falling, start to rally again. But look, cross down below the 1 standard deviation right there. Right? So now we're down in here. We're getting ready to go back up. Looks like to me. That's what it looks like to me. Do we need to go look at Microsoft and see if they're making money? MSFT. All right. There they are. They're buying a little bit of their shares back. But look at them. Earnings per share. Look at them making money. Yeah, we want to own Microsoft. Of course we want to own Microsoft. Who doesn't want to own Microsoft? All right. So if you want to buy Microsoft, buy low, sell high. It's low right now. There's an opportunity. NVIDIA. Ooh, what a market. It barely dipped below the 100. There was your buying opportunity to get into some NVIDIA right there. I bought a bunch of NVIDIA right there. But I wasn't, because it's so high, it's still, I mean, if you look at the up here, you look at this delta cone of probability, it's back down in here, right? It's right down in here. So it hasn't come down here. But this thing looks like, to me, it's going through another accumulation. They popped it. It's going through another accumulation. I think it's going to go up some more. I think we're going to get some additional accumulation in here. I think the market's going to rally. It could fall. Nobody knows. We're just making speculations. But I wanted some. So when it came down here and I bought some, and I also came in and I bought a put, right? I bought a put. Protect me to the downside. Bought some insurance for my $100,000 investment. Buy a little insurance in there just in case it does flush down. Then you can sleep at night. 100 shares is $17,000. That's not too bad, not too bad. So just put 17,000 in, buy a little put option, and go to sleep at night. Don't worry about it, because if it goes down, well, 1,700. How much you pay for this option? $1,100. Well, the market only has to go at 100 shares, $1,400 only has to go to here before it pays for the option, pays for the insurance. And it's got 100 days to do it. You don't even have to hold it for 100 days. You just hold it for a couple of weeks. And if it seems like, oh, yep, it's good, you can get most of your premium back. Okay, spend a couple $100 to protect yourself so you can sleep at night. And then if the market looks like it's taking off and going to the moon, well, get rid of your insurance premium. You don't need it. Don't need it if the market's going to the moon. Okay. Let's look at the last one, is Tesla. Tesla's below the 100-period moving average, is crossing over. I'd buy some here. I did buy some here, I guess I should say. I bought some here. I'm not telling you what to do. I'm only telling you what I'm doing. This is what I do, all right? Not telling you what to do. But this is a nice little run here. Look at this. So you have to look at Tesla, because you have to think about what happened to Tesla. They went through their accumulation stage back here, right here. Right. See that? Accumulation. And then they took off and ran like crazy. They took off out of that thing just like normal. But then it did this. Why did it do that? Well, Elon got involved in politics. Remember when he did that? Went over there and ran the Doge? Well, nobody wanted to buy his stock when he was being stupid and running around with Donald Trump, right? So his stock lingered a little bit over here. But then he said, you know what? I'm not going to do that anymore. I'm going to go over back and run my companies again. And so they said, oh, if you're going to go run your companies again and quit trying to run America, then we're going to buy your stock. And so it started to go back up through the thing. So this ended up being an accumulation stage, a reaccumulation stage, probably for the big banks and hedge funds. They just kept buying anyway, because they're like, hey, this is just an opportunity for us to buy some cheap Tesla. And then they ran it, and away it goes. Went way up here. Now we're way up here, and we needed it to pull back, give us a little digestion so that we can get in ourselves, right? So that's a nice little spot to get into. Is it going to go one more drive? This is drive 1, counter trend, drive 2. Is it going to come down here, give us a little drive 3? I would hope so. Why? Because I'm greedy. I want to buy it down here below the 200-period moving average. That's where I'd back the truck up, man. I'd sell my house. I'd sell my cars. I'd sell my kids. See ya, boys. Gone. I'm buying me some Tesla. All right, down in here. This would be a great place to buy some Tesla, because I think Tesla's going to go to the moon, and I want to buy it when it's low, because I'm greedy. Let's go look at Tesla. Is Tesla making any money? TSLA. Come on, Tesla. Look at that. Well, they're kind of rolling off a little bit off here, because they're making some switches. They stopped making 2 car lines. Why? Because they're going to start building robots. Do you think anybody's going to build their robots? If you think anybody's going to build their robots, you'd want to sell your kids to get enough money to invest in Tesla. If you don't think anybody's going to buy their robots, you think their robots are stupid and nobody's going to buy them, then you probably don't want to sell your kids. Keep your kids and just sell your house. All right. So Tesla's having some struggles right now, which is good for those of us. Look, they're even buying their shares back to try and prop up their earnings per share. They're making transitions. There's number 1 selling car in the world, but they're having a little trouble right now. Buy when there's a little bit of blood in the street. That's okay. Tesla's a great company. They're a great company. Got a great future ahead of them. So this is an opportunity for you to get into a little bit of Tesla. Maybe if we're lucky, we'll get them to come back down into here. Right? You buy a little here. And if you want to, you can buy a little here. Let's do it. Let's do it. Easier to do it than to say it. Come in here, buy 100 shares, right? Buy 100 shares, and we're going to come over here, and we're going to protect it. We're just going to buy a little put option. Buy a little put option. Just put it right in here. Just right there. Little tiny deductible. It depends on how much you want your deductible to be. Right there, $3,000, what it's going to cost you to buy that little bugger. Now, there's other ways we can do this. There's other, the 1-1-2 strategy, 2-2-1 strategy, 3-3-1 strategy, the 1-1-2. There's all kinds of ways that we can model this. But for now, just the simplest, easiest way is just to come in here and put this in like this, right? Just to buy a little insurance policy to the downside, just in case it does turn flush, just to keep us so we can sleep at night. All right, I'm going to try and mark it into that just for time's sake. Do let me have it? Nope, not with the market. It took it away. All right, we'd have to use limit order. Oh, no, it says it put it to me. It gave it to me. It's there. There it is. Just took a minute. All right, so now we have our little bit of insurance. Oh, it did give us the American Express one too. So after all, yep, we got American Express. So we got American Express and we got Tesla. Okay, so we got a little insurance policy to protect us to the downside in case it does turn and fall. And if it does, we'll just get rid of our insurance policy and buy more down here. You can liquidate here if you want to, and then buy more down here. It's up to you. We don't know. It's dollar cost average on the way down. Just buy on the way down. Yeah, so you build yourself a pyramid. All right, guys, that's all I got for you today. That's the last one of the two big majors that we talked about. And tomorrow afternoon, we're going to have day trading. So for the day trading class, we're going to do a little day trading tomorrow afternoon. And then we're going to have class again on Wednesday night. And then Thursday morning, we'll do another lab where we'll go through and we'll go to the next level because we're going to learn a whole bunch of really cool stuff Thursday night. Don't miss Thursday night's class at the university because it's going to be amazing. And then we're going to come to the lab and we're going to practice what we preach. And then we're going to put together another portfolio. So don't go running out and buying all this stuff because Land's saying, oh, this is all neat stuff, because we're going to learn how to buy some of these things different ways. All right. Different ways to buy into the same markets. And we're going to do that on Thursday. So I know, get excited. It's fun. I know it's exciting. Hold your horses. I know. It's like there's opportunities there. We're going to miss these opportunities. I got to do it right now. There will be more opportunities. I promise you. All right, that's what we're going to do today. And for those of you who don't have Pit News Magazine, you need to get it. Go get your Pit News Magazine. All right. Why? Because that's how I gauge how serious you are about being a trader. And if you have Pit News Magazine, I'm going to do everything I can to help you. If you don't even buy Pit News Magazine, it's $39 a year. It's not like it's expensive. It's a trigger for me. Let me know this guy's serious. I'm willing to help him. If he's not willing to even go as far as to buy Pit News Magazine, don't call me. Don't ask me for help. I ain't going to help you. All right. Pit News Magazine is not because it's expensive and not because I make money. It's because it's a trigger to show me that you are serious. And if you're serious enough to buy my little magazine, you're telling me, Lan, I'm serious about this. I want your help. I will help you. You're not willing to even buy Pit News Magazine? Talk to the hand. Go away. Don't even subscribe to my channel. All right. That's just my own personal opinion. It's you gotta if you can't ask me questions if you haven't read the magazine, because the answers are in the magazine. That's where I put all the answers to the questions you guys ask, in the magazine. It's been sitting here for a long time. Sorry about that, Kurt. All right, so you got to come to the magazine because this is where I put all the answers to all the things you ask. All the things you ask are in the magazine. All kinds of great stuff. We even have fun. Look at this. We even have one of these things. What do you call those? Word crosses. We have poems. We have very few ads, almost no ads. That's a great little magazine. All right, guys, give me the signal that you want some help and I'll help you. Buy the magazine, you get the signal. That's the signal you want some help. Now, here's another thing. Here, I got one more thing I want to share with you. Is that what this is? No, this is the wrong thing. We're going to have a live seminar for those of you who are in the St. George area. My son is flying out from Nashville, and I thought I had the thing right here. I don't have it, but we're putting together a live seminar. It's going to be on. I'll have more information for you. I'm just kind of giving you on the 21st of February. Make sure you set that date apart. If you're gonna fly in for it, that's great. Or if you're going to be here in the area, that's great too. We're going to have a live seminar, probably down at one of the hotels. We're trying to get into the Hyatt right now. It might not be the Hyatt, so I haven't got those dates finalized, but I do have the restaurant set aside. So anybody who owns Pit News Magazine and comes to the seminar, I'm going to buy you dinner at the restaurant, which is actually going to cost me more than the magazine subscription. So it's like getting the magazine for free, but you need to buy the magazine just to show me that you're interested in my help, and then I'll help you. And then if you come to the seminar, I'm going to buy you dinner, which costs more money than the magazine subscription for a whole year. Okay. So you get a free dinner, anybody who comes to the seminar who owns the magazine. If you don't own the magazine and you come to the seminar, well, you have to buy your own dinner. It's like $35. Okay. It's $39.99. $39, same as the magazine. And then the seminar itself is actually being sponsored by Portfolio Matrix, which is my son's company. And we're going to put this on, and it only costs $200 to come to the seminar. But if you own Portfolio Matrix, the seminar is free. Okay. So if you own Portfolio Matrix, seminar is free. If you own Pit News Magazine, dinner is free. Everything's free. If you don't own those things and you want to come, well, you have to pay. All right. That's how it works. And so this is actually trying to be nice to the guys who are members of our organization. We're going to give you a free seminar and free dinner. All right. And so to come and be a part of it, subscribe to Portfolio Matrix and get Pit News Magazine and come to the seminar. And we're going to help you learn how to do all this stuff. And the next step, which is really the cool stuff, which is being an entrepreneur for step number 3. All right, guys, I've blathered long enough. I'll let you go. We'll catch you guys tomorrow afternoon for day trading. That's the next time we're going to meet. And then tomorrow night for our class. See you then.
All right, that wraps it up for today. If you got something out of this, do me a favor. Like the video, subscribe to the channel, and share it with someone else who's trading or learning.
Hey, don't forget to tell them to subscribe to Pit News Magazine.
Oh yeah, definitely subscribe to Pit News Magazine. You'll thank us later.